This problem gives us a chance to calculate interest and practice our interest calculations. Throughout all of these, it remains the same. We have a $6 million loan, and it was taken July 1st. So we have 6 months left in this year. Then it says, assume the following things. Well, for all of these, we know it's going to be 6 million, so we'll just fill that in and be done with it. That's not going to change. So in each of these four scenarios, we borrowed or lent $6 million. And when I say borrowed or lent, I mean that because remember, as we saw from exercise 8, 3, and 4, the borrower's transactions and the lender's transactions are for the same amount of money, just different labels on the accounts. So under the first scenario, they say, assume the interest rate is 11%, and the fiscal year ends 12/31. So we have all of July, all of August, all of September, all of October, all of November, and all of December. That's a full half of a year. That's 6/12 in accounting speak. And if we multiply that out, we come up with $330,000. That would be the interest expense or the interest receivable, depending on if you are the lender or the borrower. The next scenario they give us says, suppose that the year end is September 30th and the interest rate is 9%. So September 30th is all of July, all of August, and all of September. So that's 3/12. And when we do the math, we come up with $135,000. And again, that is the amount of interest received or paid on that note at that time, or the appropriate adjusting entry for that time. And the next scenario, they tell us that it's a 10% note, and the year end is October 30th. So now we have all of July, all of August, all of September, and all of October. So that's 4/12. So 4/12 times 10% times 60,000, 200,000. And again, that would be the amount of interest earned or the amount of interest expense that occurs. And then the last one, they'd say, suppose that we have a 7% note and the year ends January 31st. So we have all of July, all of August, September, October, November, December, and January. So we have 7/12. Okay? Now remember, this is only because their fiscal year ends 12/31. If their fiscal year ended 12/31, we would do this. It ends 1/31, so we do 7 months. So 7/12 times 7% times $6 million, $245,000. And again, that would be the amount of interest that would be owed or expected in terms of interest receivable or interest payable based on those time frames and those interest rates.